Howdy, folks. Dr. Jeff Camarda. It is Thursday, July 9th. With a sit down, you may want to pause, get yourself a cocktail or a cup of warm tea. This is going to be a very long video on a day when the Dow and U.S. markets were showing considerable weakness, down about 400 points last time I looked. It's still open now. But this is kind of a quarterly special report that Joyce asked me to write and include in your statements, which you'll be getting soon, and long overdue. So thank you, Joyce, for suggesting that. So I'm going to go ahead and read this. Forgive me. I know there's a glare on my glasses here with the camera. I wish I could find a way around that. And I'm going to be looking up using the monitor as a teleprompter so I get every word right. But here we go. And this is a piece that also will appear in Forbes called "Does S&P 500 plus U.S. economy equal COVID market stock bubble?" And let's hope not, but I'm afraid that it does. So with stocks clearly defying COVID-era economic reality, investors like you may rightly ask themselves if they found themselves yet again in bubble land. Already gut punched by COVID-19, investing in stocks has seemed to become riskier and riskier as corona cases mount. I don't care if you're in index funds, S&P 500, or a single individual stock, and many of you are in those or all of them, but you can't help but have noticed that stock prices seem to have become unhinged from the black pit that the global economy has been dancing on the edge of for a couple of months now. Some may ask themselves why the S&P 500 is not a good indicator of the U.S. economy. It usually is. And this is a very valid and important question. The implication, of course, that stocks are high now, at or near records on the Dow, the S&P 500, certainly on NASDAQ, because they're high because economic good times are on the verge of coming roaring back. But are they? In my view, that's very doubtful. The stock market is a leading indicator, to be sure. It tends to go down before the economy gets slammed and go up before the unemployment rate and other economic measures show improvements. But Mr. Market, Mr. Market, he's a very fickle customer. There's an old saying on Wall Street that the market can stay irrational longer than you can stay solvent. This is usually applied to short sellers who sell stocks when a market is with no logical reason to stay high, must come down. So they sell at a higher level expecting to come down. And often, unfortunately, they get outvoted by irrational investors paying crazy prices for overvalued stocks. Could that be happening now? Investment in the stock market always carries some risk. It's unavoidable. Stock trading is not a perfect game. Mutual funds can gyrate wildly. Knowing when to buy and sell in the financial markets in the best of times is a mysterious process. Now, right now, things may be good on the New York Stock Exchange, but are they good in the real world where people make and spend money and fuel the profits of the companies in the S&P 500? Ask yourself, those around you, are these normal times? Are they robust? Do you feel fat and happy and wanting to spend money? Are companies making a lot of money? No, it's not that happening. There are two massive and opposing forces now acting to shape investors' views on stock prices now. And again, a real world where people make and spend money to fuel the profits of companies that we invest in, it's a whole nother game right now. So the first of these massive opposing forces is the unprecedented, devastating chill that COVID has placed on global commerce. For most companies, I mean the overwhelming majority around the world, the lifeblood of sales revenues, sales and cash flow, without that, companies wither and die. The lifeblood of sales revenues are way, way down. Bankruptcies are hitting the wall left and right. Businesses, small and large, are barely clinging to life. The economic fuel of consumer spending is decimated by layoffs and fears of layoffs. And regardless of what the politicians or wishful thinking may say, we are really just in round one of this calamity. The worst impact on health and economics is yet to come, and probably not, in my view, due to 2021 or later. And that's before you even get into the dynamics of what's happening politically with the presidential race and a higher probability that regulations and taxes on companies and taxes on individuals will spike up next year. That certainly is going to be an additional dampening effect, which I'm not really addressing now, but will soon. So why is the marketing partying like it's 1999? Whoops, there was a big crash after that. Well, the Fed has never ridden to the rescue quite like this before, not during the Great Depression, not even during the Great Recession of 2008. Never has the Federal Reserve been so loose with printing press cash or so eager to intervene in the markets by buying to prop up demand and prop up prices. Again, they're actually buying securities in the markets in order to have artificial buying pressure to skew the supply-demand equation so prices stay firm. What's the net effect on this? I mean, by the way, this is pretty much ditto for central banks around the world. They're just printing cash, dropping cash by helicopters in the Bernanke sense, doing whatever they can to juice the economy. Now, this is Kool-Aid of a very, very high order indeed. It's literally juicing the economy, an economy on intensive life support, mind you, and it's serving up a crack pipe high to too many stock investors, all at a proportion to the life support med drip to an economy that's at death's door. I mean, this is not like methamphetamine or crack on somebody that's already, bouncing off the walls. This is the economic patient is in dire straits here. It's barely keeping alive. So why do I say that? Ain't low rates and lots of easy money good for business and good for stocks? Of course it is. You can bet your bottom bippy on that. But when it comes to stock investors' expectations, what looks like all the money in the world may really be like trying to fill a mine shaft with a teaspoon. And even the open checkbook Fed is making futures murky and dangerous noises. They're not saying good times are here again. They're saying, gee whiz, we got some real problems here. That's why we're shoveling the cash in. We don't know what's going to happen. They're making dangerous noises, which of course is the reason for the open checkbook. Let's do some fact checking. Stocks are now trading near their peaks back in 2019. NASDAQ has been hitting record highs in the wake of the COVID crisis. Now, there are two things about 2019. Number one, back then, the worldwide economy was singing. You might say that stock prices were justified by corporate profitability. Companies were making money hand over fists. You may have noticed that things are a little bit different now, but you couldn't tell that from stock market prices. And even last year, when good times were undeniably rolling, no less pundits than the likes of Nobel laureate Robert Shiller, you remember him, predicted the last bubble. He's a Yale Nobel Prize winning Yale finance professor, the irrational exuberance guy. Shiller and others were warning that stock prices were in a bubble last year and bound to come tumbling down. And again, things are a little bit different and darker now. Companies' financial statements are crushed and unpredictable. The future is so uncertain that many are not even issuing guidance of expected revenues and earnings. So how to value stocks? It's been said in the long term, the market is a weighing machine, but in the short term, it's a voting machine. In more sober times, one looks at future earnings, weighs the earnings capacity of the company, prospects for growth, profitability, competition, place in the industry, weighs all these things, ties that back to a fair value, kind of like pricing a house based on how much rent that you expect you're going to be able to clear. This is called fundamental analysis, and it's the weighing machine part. Right now, there's no way to weigh, if you'll forgive the pun. For most companies, future revenues are just unknowable. Estimating profits and assigning prices is really just shooting in the dark. So that leaves the voting machine, the popularity contest, the gee whiz, what if, let's hope, maybe, I can make believe things are brighter than they are. This method, prone to wishful thinking and always trumped by the weighing machine in the end, tends to produce some wacky results, both on the undervalue side and I think now on the way overvalue side. Right now, things look to be wildly overvalued. If Shiller was warning bubble last year when the economy was rocking, what does that say about now? Are we in a stock bubble? Well, I've dredged up a few quotes from a PhD class I did a few years ago on stock bubbles, and see how these move you. See how you react to these in the context of today's world. The Financial Times defined a bubble as when prices of securities or other assets rise so sharply and at such a sustained rate that they exceed valuations justified by fundamentals, making a sudden collapse likely, at which point the bubble bursts. Schiller, our friend Professor Schiller said that I define a bubble as a social economic that involves extravagant expectations for the future, social mental illness, excessive self-perpetuating feedback fed by greed, envy, enthusiasm, media amplification. Are you amplifying media? You certainly are. Regret on missing out and fear of not catching up. Ron Insana noted that bubbles, and these are the best quotes, I think, are a recurring phenomenon. People persist in chasing prices divorced from underlying economic activity and seem not to learn from the past or apply rational pricing rules during euphoric periods. Bubbles form when the price of the asset becomes divorced from the underlying economic realities of reasonably anticipated profits. Any significant increase in the price of an asset that cannot be explained by the fundamentals. Bubbles amount to massive delusion. Too often, people fail to remember that trends don't go on forever and they don't learn from the past. Hopefully we do. Hopefully we here at the Camarda family do. So are we in a bubble? It sure looks like we may be to me. It really does. Stock prices seem utterly disconnected from reasonably predictable earnings for a year or more. For this reason, we continue to counsel extreme caution. Keep lots of dry powder. Odds are strong that price will drop and much better buying opportunities will present down the road. Be calm, hedge your bets, be patient. I know it's hard with the market bouncing hard. Gee whiz, I'm missing out. The discipline is critical, but in the end, I think it'll pay off. Hedge your bets. Keep some stock exposure because we may be wrong, but emphasize companies with clear guidance and sectors that seem favorable in today's challenging economic times. Now, this is Camarda's investment philosophy in the current world, and we're running client portfolios. Got to move around the camera here in line with it. So that's it. Sorry to be so bloody long-winded, and I'm just going to wrap this up real quick now. Thank you so much. Be safe. God bless you, and you can look forward to a much shorter video tomorrow. Thanks again. Now, how do I turn this darn thing off? There we go. Bye-bye, guys.